Hello and welcome to RJS TV. It's June, it's the big run to the end of the financial year, and who better to join us on the show today than the man that gets very excited at this time of the year, Roy Sanderson. Roy, I believe it's one of your favourite times of the year.
It is, Dave. I love this time of the year because there's lots of tax planning being done with clients, and generally when you do tax planning, it's happy clients.
So you mentioned tax planning. Do you get a lot of late inquiries? Is it important to get in, what have we got, 12 days till the end of the financial year now, or 11?
Well, tax planning probably started about early to mid-May each year, and we just work through it with our clients. Once we get past the March BAS, that's probably the best time because we have year-to-date figures. So, yeah, we've been doing tax planning for a while and we're wrapping it up pretty much now.
Plenty of tax tips coming up later in the show and a fantastic offer for viewers that you won't want to miss. But as we always do, Roy, let's get into our news headlines. GDP growth has been something that we've put on the agenda over several episodes, several months. And you can see that over the last 5 years, growth is starting to deteriorate in Australia. And I think that the numbers here show particularly that after the post-pandemic resurgence, growth has really struggled to get up towards that 3 to 4% where the government's targets are.
And isn't it interesting that it's on a downward spiral, but there's statistics are available that suggests that if immigration was not as high as it has been, then our GDP growth would be a lot lower.
These are the year-on-year numbers for the last 5 years. Let's contrast that to the 5 years prior to COVID. Now, different axes, so don't be too concerned by the height of the bars here, but you can see that certainly plenty more quarters where the year-on-year growth rate was much higher than 2% and up towards the 3%. So you can see that it is certainly below where it has been prior to the pandemic, and it's an area that governments need to address, as we've talked about, but it's going to be hard. And the reason I say that, Roy, is because confidence in the community is flatlining at the moment. Consumer confidence is now has now been below 100 for the last 2 years. So that's the worst it's been since the deep recession of the early 1990s.
Yeah, and if you look back at where it was late last year, it was terrible. We thought it was going to jump up and continue jumping up early 2024, and it's dropped way back down again. So disappointing.
The other problem, as I said, that confidence is poor in the community. It's not just consumers, it's business confidence as well. So you can see that business confidence is down, and that's been worsened by declines in manufacturing, transport, construction, as well as sales and retail. So I'm sorry to say to our viewers, and I'm sorry to say to you, Roy, it's a grim picture out there at the moment. There's low GDP growth, consumer confidence is low, business confidence is low. What is there anything that you think at this point we could do as a country, as a state, as community to supercharge things?
I don't have the answers, Dave. We certainly have some problems, and we really hope it does turn around.
We absolutely do hope it turns around. And I'm like you, I don't have the solution, but what I've said on previous shows, and I'll say again, is we need some ideas. We need to start thinking differently about some of these problems that are confronting. That's housing, that's climate, that's tax. We need to start thinking differently and try some new things because what's currently happening is not working. So what do they say? The definition of insanity is doing the same thing over and over again and hoping for a different outcome. Well, we're not getting a different outcome anytime soon, Roy. And Australian exports is another area that is affected by this, now at a 28-month low. So again, we're not painting a very nice picture of the economy at the moment.
How much bad news have you got today, Dave? This is all bad news. Hopefully this might improve, exports might improve, given that we've recently shaked hands and hugged China, which might increase exports, we would hope.
One area that I think we can have maybe, or that is maybe an area for some good news, is that unemployment in the country has been relatively low. So it's still there in in the main number at 4%. So it's still relatively low, particularly if you contrast this against the historical unemployment rate. So as we look at this, as we look at the rate that when figures started being collected from the late 1970s, you can see that it is still at quite a historically low level, not as low as it was 2 or 3 years ago, but it's still quite low. Now, Roy, what I wanted to ask you, or what I wanted to show you today, we talk about inflation a lot. The inflation rate is starting to come down. It's at 3.6% at the moment on this particular measure of the inflation rate. We know that there's various measures of the inflation rate. There's the CPI, there's the trimmed mean. So the government and the Reserve Bank use various measures of inflation, but you can see that inflation is certainly on a downward trend. So what's interesting to do in this situation, Roy, is to contrast inflation with unemployment. Now, there is an inverse, historically there has been an inverse relationship between unemployment and inflation. And if you look there, particularly, the period of time in between sort of 2004 and 2009 as a clear example, when unemployment goes down, inflation goes up, and vice versa. So what the government and what the private sector is effectively trying to do at the moment is to achieve a situation that is historically not achievable, which is low unemployment and low inflation.
Because it's very rare we've had them correlated together.
It is. So the question is, can it be done? The government is suggesting yes. Probably there are some private sectors that are saying no. We're seeing lots of noise being made in the community about wage rises at the moment, which is certainly going to affect the business sector. It's going to affect everyone. So it's a wait and see on that. Can unemployment remain low and still and can we still continue to curtail inflation? Only time will tell. Roy, let's have a look at the stock market. Noted that the Commonwealth Bank has achieved a historical high price. I think actually we're going to jump ahead to the rolling quarterly change here in dwellings. Yes,
we can see here that Melbourne is at negative 2%. And historically, that's pretty poor apart from what was happening in May 2022, so 2 years ago. But of all the states, Melbourne seems to be it's in decline. I was going to say not increasing as much as other states. It's certainly the worst performer across Australia.
The home value index over the last 3 months paints a particularly poor picture for one city, Roy.
Yeah, Melbourne again. This is 3 months, by the way. It's negative 0.2, the worst performer, and the only one that's in negative. So, yeah, Melbourne not doing well at the moment, and we'll see why on the next slide. One of the reasons is that there's 39.4% more properties on the market today compared to 12 months ago. And in country Victoria, it's 42.6%. And I know the left-hand box says the average across Australia is 17.2%, but if you take Melbourne out of that equation, that average is going to drop to somewhere around 8 or 9%. So we have a lot more properties on the market in Melbourne. That's a problem.
Yeah, interesting. How is that affecting rents?
Well, what's happening with rents is in Melbourne itself, which is the second bottom part of the slide, is 9% growth, which is not far off average for some of the other major states. But I think that if we have investors leaving the property market in Melbourne, then we're going to have more pressure on rents. So watch those rents. I think they're going to jump up in Melbourne.
Roy, the next slide is a really interesting one. You've dug out the dwelling approvals over the last 30 years. Talk us through this one.
So are we building enough property to cover the population growth? And you look at where we're at today and compare that to 30 years ago, we're building less homes by about nearly 4,000 less than what we were 30 years ago when the population was significantly less and the growth in population was less. We're well below the last 10-year average. So we have some serious problems across Australia in relation to housing. And I know we bang on about this in the show, Dave, but the housing crisis is getting worse and worse.
That is quite a damning slide because, as you say, as is illustrated there, we are currently below where the decade trend has been, and despite the fact that we are in a housing crisis there. So, and despite the fact that, as you mentioned, that we've got high immigration numbers. That slide reads quite clearly, like we have a supply issue in housing. We have a serious supply issue in housing. Roy, do you think enough efforts are being made to curtail the supply issue? Because the government is coming out and saying, oh, we're building more houses.
Well, I think what has shifted is the supply is shifting from personal private investors building investment properties to the government, where they're spending our taxes on housing because they have to, because we're discouraging property investors.
Interest rates remain on hold after the Reserve Bank's meeting yesterday. There was some speculation that they could still go up. So that's good news for interest for mortgage holders and for borrowers in general, 4.35%. The question is, do you think they'll still go up or do you think they'll stay?
And I think congratulations to the ANZ, who have said all year that there'll be two interest rate rises this year, have just come out and said that they now think they'll be on hold until early next year. And if they had listened to our show from 3 or 4 months ago, we've been saying for quite some time, I think interest rates will be on hold for all of this year. I don't think there'll be a movement up or down.
And the other thing, as we saw earlier in the show, the inflation rate is starting to come down. So it's still a delicate balance. There's still movement in interest rates around the world, which we know are measures that the Reserve Bank look at, and economic conditions around the world certainly impact us. So it's still that delicate balancing act. But it is interesting, Roy. It's become kind of a part of sort of workplace culture now, where on that Tuesday that the Reserve Bank meets, someone at the workplace puts their hand up and said, hey guys, everyone, just an announcement that the interest rates are on hold. It's such a big issue, such is the cost of living crisis at the moment, that, there's a workplace announcement. These are things that are sort of usually reserved for, babies being born or, marriages or those kind of announcements. Now it's people talking interest rates in the hallways.
I thought it was just our office that did that. Every announcement. It's all around the world, is it?
Absolutely, and I think that sort of talks to the significance of it now. We talked about this last month on the show, but what used to be people sweating, tax and sweating budget surpluses, it's now people very squarely sweating the interest rate and the Reserve Bank interest rate or the cash rate, because as we know, there's the borrowing that is required to buy a house in the market at the moment is a very, very significant financial decision for households. So even slight increases or decreases in the rate are going to affect personal budgets significantly. So, it's become sort of a blockbuster announcement in offices all around the country, and it was a favourable announcement, albeit not the most positive it could be, but still a favourable announcement yesterday. Roy, end of the financial year's coming up. Time for tax. This is the meaty part of the show that we love to get into. It's a tax tip. But before we get to that, as has been on the agenda for a long time now, that everyone, it's not a secret anymore. It wasn't a secret before the budget. Stage 3 tax cuts were amended earlier this year or late last year, can't quite recall, but here are the new Stage 3 tax cuts. How's it going to affect people from July 1?
Yeah, well, you can see on the second line, 18,000 to 45,000, we get a 3% reduction in our tax, so 3% more in our pockets. And for the part of income that is between 45 and 120,000, we're getting a 2.5% reduction. So we will have more money in our pockets come July 1.
Tax tip for this week, for this month, I should say. Some good ones on there. Talk us through these, Roy.
Yeah, so the first one I've mentioned before, vouchers up to $299. Even if your salary sacrificed, I know, Bunnings, Coles, Dan Murphy's, my favourite one. You can get vouchers for $2.50. You don't have to go to $2.99. It's tax-free to the staff member. The employer gets a tax deduction for it. He claims the GST on it. And there's no fringe benefits tax on it. It's just a no-brainer that you would do that. Electric vehicles, there's the limit. And this finishes in April 2025. If you owned a business and you're okay to buy an electric vehicle or a hybrid, plug-in hybrid, then you should positively look at this because there's no fringe benefits tax. So the car becomes tax-free or a tax deduction. And if you do need a car there and you're a worker, approach your boss to see if they will allow you to salary sacrifice. And the final one there is a common question is, how can I get more money in my tax refund when I'm not spending much money on deductions? So you're about to get more money in your pay packet. Maybe go to your employer from the 1st of July and say, I know I've got another 3% in my pay packet. Can you just take an extra $20 in tax each week? And that'll give you just over $1,000 additional refund at the end of the year. It's a no-brainer. If you want to use it as forced saving, get the boss to take more tax out.
Just going back to the electric vehicles and fringe benefits tax, can you give us a bit of a framework of how someone would approach their employer about this? Because sometimes it's intimidating for an employee to have that conversation. How have people managed those conversations through your experience?
So what you do is you go to your employer and say, I've spoken to my accountant, me, RJS, and they've suggested that I buy an electric vehicle and I salary sacrifice it. And they have a knowledge or a relationship with an organisation that does all the salary sacrifice stuff for you. They look after our salary sacrifice and they're like a manager of it. And it only costs about $300 a year, $350 a year, and they manage the whole process. You drop your wage by the equivalent of what the car costs. The employer wins because they're getting a tax deduction on the car. You win because your wages are lower, so you pay less tax. It's just an easy thing to do. You just follow your instructions from 1 to 10. So easy.
Yeah, I mean, it makes a lot of sense. You just got to have the confidence to have the conversation, and then the follow through, I think, is the important part. But it makes a lot of sense. It's a good incentive for people out there. And just a question without notice, if you're sort of looking, and I know you mentioned that tax planning has happened a lot in the lead up to this, but as the end of the financial year approaches, are there any other things that should happen in the next 10 days? As opposed to the 10 days after the start of the financial year?
Well, there's a couple of things. Firstly, superannuation. That is only a tax deduction if you pay it before June 30, but do not wait until June 30 because it's not important when it leaves your bank account. The critical date being 30th of June, it has to be allocated by the super fund into your account, allocated to you. So you should be paying your superannuation as early as possible in June. If you're leaving it until the 25th of June, you may be too late. So I'd be paying your super as soon as you can. That's important. And if you have a land tax assessment bill that you got in February and you haven't paid it, if you don't pay it before June 30, you don't get the tax deduction for it. And then thinking you've paid it in July, you'll claim the tax deduction next year. That's not how land tax works. That's one item that you can only get it in the year you pay for it if it's the current due year and not a past due year, which is not a well-known rule.
Always some nuggets of gold there in the tax tips. And we've got another question that's come in from one of our viewers. Two-parter this one, Roy. I plan to sell my investment property in Victoria due to land tax. I am travelling to Queensland to inspect a property. Can I claim the travel cost to buy the property?
The first answer there is no. Think through the logic. I would otherwise, if I was allowed to claim travel to search for a property, I'd be looking for an investment property in Paris, London, Italy, and claiming the travel costs. So we definitely can't claim the travel costs when you're looking to purchase a property.
Okay, that makes sense. If I do buy the property, will I be able to claim travel to inspect the property or to go up and do some repairs?
Up until about 4 or 5 years ago, the answer was yes, but the government have changed that. No travel for inspections or repairs by the owners are tax deductible any longer.
Not fair.
Not fair.
That's a good way of teeing us into this segment, which is Roy's Rage, because you found something else that is not fair, not reasonable. You like to find these things and you like to go on the long run in this segment. What have you got for us this time?
Well, another accounting firm, they're not accountants, they're taxation consultants, I need to be fair. They came out and made an announcement that you could actually get your refund up to $1,000 straight away on the day you do your tax return, or it goes into your bank account overnight, and you pay a simple $50 or 5%. And they announced it like this was the first time and it's going to help people out in a crisis and money's tight, so isn't this a great service? RJS started this in 1993, 31 years ago when we opened our business, but back then refunds took anything around 3, 4, 5 weeks. So people were paying $50 to get a $1,000 refund straight away on the day. So this isn't anything new. In actual fact, today we discourage clients from doing it because if you see the second bottom line, a 5% fee for a lender, the refunds today come back in 7 days. That's the equivalent of paying 260% per annum. So H&R Puff and stuff who made this announcement, you should be embarrassed because that's the rate you're charging your customers, an equivalent rate of 260% per annum, because you're giving people their refund money today instead of waiting the 7, 8 to 9 days.
Bang, bang. Another one that is torched on the world famous Roy's Rage segment that's now been running 5 years. Can you believe it? There's been plenty of victims. One thing that I did mention off the top of the show, Roy, is that there was a great offer for viewers of the show and for the broader community. Talk us through this one.
Yes, if you have a company, a family trust or a self-managed super fund and you want to come to RJS, probably recommended by somebody already using us, we will give you a $1,000 accommodation voucher, which is all tax-free, and you can use that over the next 18 months. So think about changing accountants if you're not happy with who you're with. Of course, if you're happy with who you're with, you stay where you are. But if you're not 100% happy, shift to RJS and you'll get this little accommodation voucher.
Now, Roy, we love a shout out. Shout out to this one first up.
Yeah, this is a great business. These are corporate branding items. If you think about an item any item, it can be corporatised. You can put your logo on it. These are people who we have used, RJS have used, awesome products and awesome service. So big shout out. If you need anything branded, reach out to them.
What's that? Took us through the beanie there. It's got.
Well, look at those beanies. These are new on the market. They're actually Bluetooth beanies that you can link to your phone. So when it's cold, Victorian winters, we're famous for it. You can go for your walk or your run, put your beanie on to stay warm, but Bluetooth your phone to a little headset. How awesome is that?
Brilliant. We're officially in the future. That's brilliant, Roy. You got one more shout out for us?
Yeah. This is a great organisation, Apex HR. They really do specialise in looking after real estate agents' HR issues. They have great services, compliance advice. They do auditing, training, development. They even have a Cert 4 in real estate practice. They are a fantastic business and great people, good humans. So if you're in real estate, either starting or established, you should be reaching out to these people who can help you.
Roy, 30 June coming up. Before we finish the show, any plans? What do you like to do on the 30th of June?
Well, we've got a bit of a party on at RJS. We do celebrate Friday night. We've got a bit of a function. We've got all our country team coming together for a day of training on the Friday leading into the new year. My advice would be also, if you want to get your refund in a hurry, don't come in on the 1st of July. It's just too early. Put it back to about the middle of July, because by then the ATO should have their information from the employer, interest rates, dividends, private medical cost details, information we need to do your tax return. It needs to land at the tax office, and that can take a couple of weeks. So don't come in on the 1st of July.
Plenty of good advice in the show. I reckon you've been informed today. Roy, well done. Thank you for joining us as always. Plenty of nuggets in there. Make sure that you get along to the website rjsanderson.com.au if you ever need any advice in the tax space and financial affairs. They are your people. Thanks so much for joining us on the show today. We'll see you next time.